My name is Roger Slater. This video is actually about an actual breakdown of the financial statements, the profit and loss statement and the balance sheet. And this will be part one. Part two is where we'll actually look at most of the ratios, or at least the most common ratios that bankers and other financial institutions really look at when they're comparing the company over years, or whether they're comparing two different companies. So anyway, I do have a profit and loss statement and a balance sheet. The profit and loss statement came from LendingTree. It was an example that they gave on the web, and then also there's one from John Gilliam, CPA, and he has lessons in accounting, and it was from accountingplay.com. So anyway, and that was a balance sheet, an example balance sheet. So anyway, the two companies aren't named the same, but we'll pretend they are. So anyway, the profit and loss statement is just called the P&L statement, but it can be also called the income statement or the statement of earnings. It provides the dollar amount of sales of your product or service. It also shows the expenses or costs, and then it finally shows the profit or loss over a specified period of time. The time period is usually yearly, quarterly, monthly, but it can be for any period of time. It can even be daily. There is one manufacturer that had the individual bought a company that was losing money. It was going out of business. So anyway, he got it very cheap, and he was going to turn around that business. So what he did was he took the income statement and the balance sheet, and he posted the financial statements in huge banners on the floor of the manufacturing facility. And he actually updated them daily so the employees could see their progress. Now, this is an extreme example, but it did work, and he did become profitable. I think the employees had some incentives also built in, to where they had an incentive to make those numbers work, and to watch the progress. It's always good. I know I worked at a bank once, and the bank was just adamant, really small bank, adamant about most banks are adamant about not showing the employees really what they're making, the money they're making, because I guess they're afraid they're all going to ask for raises or whatever. This was a small bank, and it was a minority bank. And basically, the employees, the owner, went ahead and showed them the financial statements. He showed them the income statement, showed them the balance sheet. And these, I had tellers that were just amazed, and they were just like, oh my God, this is so cool. And actually they wanted to try and help and make the company make more money and more expensive, and control the expenses and everything. He did it just that once, and then he didn't do it anymore. And I was very, I was kind of sad, because I was like, these employees are kind of motivated by that. So anyway, the profit and loss statement, we really look at sales or revenue. We call them the same thing. And it lists the total sales of the company in a period of time. And usually that period is like I said, yearly, quarterly, monthly, could be weekly or daily, but usually not. Usually from the main operations of the company. The dollar number, is usually in units of almost any product or service, but it is given in a dollar figure of sales or revenue. Then there's the cost of goods sold. This represents the direct cost of producing those units or sales in dollars. It will always include the cost of purchasing the items for sale, but it can also include labor, transportation, materials, and even some manufacturing overhead. These costs are usually directly related to the sales of the product or service. Gross profit. The total sales minus the cost of goods sold equals gross profit. It is the profitability of the company's core operations before subtracting the expenses that are ongoing expenses or singled out expenses. And these are the operating expenses. These expenses are related to the ongoing operations of the business, like salaries, rent, utilities, marketing costs, administrative expenses, and depreciation. And if you notice, those operating expenses, they're going to happen whether you have sales or not, or whatever your sales are, but always in the cost of goods sold, you're talking only expenses that are related to the production of that product. Now, the probably one of the easiest ones would be a retail establishment, retail company, because what they're doing is they're just buying a product, they're marking it up, and then they're selling it. So really the cost of goods sold is really just the cost of that product. Operating income or profit. Operating profit or income is obtained by subtracting the operating expenses from the gross profit. This is the profit from the core operations of the company. Now, there are non-operating income or non-operating expenses, both. Includes expenses and income not directly included in the core operations, such as interest income, income expenses, gains or losses from the sale of assets, or interest or investment income. Net income and profit, which are the same thing, just different words for it. Net income is the final figure on the profit and loss statement and shows the company's profit or loss for that period. Net income is the operating profit subtracted from the non-operating expenses. So income statements, I mean, they can be usually what they do is they put them on a spreadsheet and they'll look at the last 3 years. So let's say right now it's actually, let's say it's 2023, which it could be. We are going to look at the years 2020, 2022, and then 2021 and 22, 2020, 2021, 2022, and then 2023. So anyway, in 23, we're going to look at an interim P&L, and basically the interim is going to be for the period of time of the year that you're in right now when you're looking at the loan or whatever. So anyway, if it was like June, it would be 6-month statement, and then you do it from January to whatever it is right now, as close as you can get to the time when you have to submit these documents to a lender or to whoever you're going to submit them to. Now the balance sheet. The balance sheet is also called the financial statement of financial position, and it really shows the condition of the company, assets and liabilities in one period of time. It represents the company's assets, liabilities, and shareholders' equity. And what I'm going to do is go over the parts of the balance sheet. On the left is always the assets. Assets are what the companies own. Like current assets would be cash, and then accounts receivable, what other companies owe you, and then inventory is what you use to make product. And then if we're looking at long-term assets, they'd be like property, equipment, or investments. Now on the liability side, liabilities include what the company owes to external parties. These are put into two categories, either current, short-term, which is the same, short-term or current liabilities, and then long-term liabilities. Current or short-term liabilities are short-term debts, accounts payable, what you owe to other companies. Accrued expenses, that is usually wages and things like that are accrued over time. And then long-term liabilities are basically loans, mortgages, bonds, etc., and they are a longer-term asset or liability. Then there's shareholders' equity. Shareholders' equity is also known as owner's equity or net worth, and mainly a lot of people just refer to it as net worth. It includes common stock, retained earnings, and additional paid-in capital. And some companies just group it all in and call it net worth. Some break it out into a number of different things, and I've seen them broke out to sometimes 8 different categories. But usually what we do is we just add them all up, and that's your net worth. Add them, or if it's a negative, subtract it. So anyway, the balance sheet follows an equation: assets equal liabilities plus shareholders' equity. The equation needs to be balanced in this way for the balance sheet to be correct, and that's what's called the balance sheet. Assets equal liabilities plus owner's equity. Both the profit and loss statement and the balance sheet are very, very critical financial statements that provide needed perspectives of the company's health. The profit and loss statement is over a period of time and shows how profitable the company is in that period. The balance sheet, on the other hand, shows the company's assets, liabilities, and owner's equity in one period of time. They are both used to evaluate a company's health and profitability. So anyway, these two were used, we're looking at these now. This is part one. Part two is going to be really the where we look at all the ratios. And these are going to be the common ratios. So anyway, we're going to cover all those, and that'll put a lot of this balance sheet and income statement, it'll really pull it into perspective on what banks look at and what financial institutions look at when they're looking at your loan, or if you give it to anybody, if you give it to investors, what they should be looking at. So anyway, please subscribe and hit the bell if you want to know when future videos will be available. Please also hit the like button if you learned anything in this video. My name is Roger Schlueter, and I will see you in the next video. Thank you.